Did you know that 90% of traders misuse the MACD? Yeah, you heard that right. It's staggering. And here's the kicker. It's not that the MACD is a bad tool. It's how traders are using it. Think about it. So many are out there, glued to their screens, entering trades based on flimsy signals, confused as to why they're losing money. Frustrating, right? It's like trying to drive a car without knowing how to steer. The MACD is one of the best indicators for spotting trends. But if you don't know its nuances, you're setting yourself up for failure. Misconceptions pile up like dirty laundry, dragging you down the rabbit hole of losses. And here's the kicker. The MACD isn't the enemy. You are. Or more accurately, it's how you're using it that's causing the headaches. What if mastering the MACD was your golden ticket to successful trading? What if you could flip the script, turning losses into wins? Mastering this tool isn't about memorizing numbers or blindly following indicators. It's about deeply understanding how to read that chart and gain the upper hand. So stay with me because we're diving into the real strategies that make MACD a powerful ally in your trading journey. Are you ready to turn the tide? You ever feel like you're drowning in a stormy sea of market noise? I get it. It's overwhelming. Prices are flying everywhere, news is screaming from all directions, leaving you grasping for a lifeline. Well, trends are that lifeline. They're your ones, helping you navigate the chaos. You wouldn't set sail without knowing which way the wind's blowing, right? If you follow the wind, if you know which direction the market's moving, you can glide over the waves instead of fighting against them. Catching a trend makes everything smoother. You're not just guessing, you're riding the currents. The truth is, without understanding trends, you're just hitting the waters blindfolded, hoping for the best. That's a dangerous game and rarely ends well. Here's an easy way to visualize this. Picture a chart. Upwards it climbs, downwards it falls. It's like the tides. They don't just randomly surge and recede. There's a rhythm. You see those waves in the movements of a stock, and if you learn to read them, you can jump on that surf. Successful traders know when to set their sails and when to drop anchor. They pay attention to those waves, and trust me, they can tell when a surge is coming or when a storm's brewing. Here's the deal. Everyone talks about the MACD like it's this unbeatable weapon. But the truth is, just using the MACD alone, it's like going into battle with a butter knife. Sure, it can find trends, but it can also lead you into a trap. Don't fall for it. You need to pair it with the right tools for it to truly shine. That's where the 200-day moving average comes in. Together, they're like a dynamic duo in a blockbuster movie, conquering the market one trade at a time. Think of it this way. The MACD is great at picking up shifts in momentum. It shows you when buying and selling are heating up. But the 200-day average? It's your strategic partner, telling you whether the overall market direction is up or down. If the MACD is your speedometer, the 200-day moving average is your roadmap. You wouldn't drive without knowing your destination, right? So how do you combine these two heavyweights? Simple. When the MACD crosses above the signal line while the price is above the 200-day moving average, it's a solid buy signal. You're not hoping the market moves your way, you're trading with the current. Conversely, if the MACD crosses down and the price is below the 200-day average, you have a prime short opportunity. Let's break it down with visuals. Picture a chart where the MACD lines dance around like they're at a party. But then beneath, that 200-day moving line acts as a bouncer, keeping troublemakers out. If the party's above that line, it's your stage. But if you're below that line, it's best to sit this one out. All right, let me hit you with something to think about. Trading is a lot like playing chess. Yeah, I said it. In chess, strategy is everything. Positioning your pieces wisely can mean the difference between winning and losing. The same goes for trading. You've got to understand your support and resistance levels. They are your chessboard in the market. Think about it. When prices move, where do they stop? Where do they bounce back? Support and resistance are those crucial areas. They're like battlefields where traders clash. Recognizing these levels can shift the tide in your favor. You see a strong level of support, you know it's a potential place for buying, right? And resistance? That's where sellers might push price down. Make no mistake, these aren't just random numbers, they are power zones in trading. Picture this, a price chart swinging up and down. You spot a level where price hits a wall, unable to break through. That's resistance. And on the flip side, when it bounces off a point repeatedly, you've found your support. Those are your signal flares. They tell you where to enter or exit, giving you an edge like knowing your opponent's next move before they even make it. Now, things are about to get a bit suspenseful. Want to master the art of perfect trade entries and exits? Stay tuned, because soon, I'm showing you exactly how to leverage those support and resistance levels to your advantage. Trust me, you don't want to miss this. Ever feel like you're sprinting on a treadmill in your trading? You're running hard, but that balance isn't moving forward. Frustrating, right? That's what chasing losses in a sideways market feels like. You put in the effort, but the price action just stalls, draining your account and your spirit, faster than you can say bull or bear. Here's the deal. Sideways markets breed false signals. You think a breakout's happening, and bam! Prices crab back? It's like trying to catch a butterfly that keeps flitting just out of reach. You reach out, but your trading account is taking a beating. Picture yourself in a congested street during rush hour. Everyone's honking, trying to get ahead, but no one's moving. That's your market when it's sideways. It creates noise, chaos, and confusion. Bombarded by signals telling you to buy here, sell there, and it leads to terrible decisions. Quick losses add up, leaving you staring at your balance, wondering where it all went wrong. So how do you escape this turmoil? Start by filtering out those false signals. Track the trend lines, those paths the price likes to follow. When the market's flat, find those channels, the highs and lows, right? You want clear breakout points. If price hits a ceiling repeatedly, hold off. Wait for a confirmed breakout. Patience is your ally here, and listen closely. Check the volume. If it's low during price action, hold off. That's a trap waiting to snap shut. Only move when volume is high during breakouts. It means people are backing their bets. Now visualize standing on the edge of a cliff, ready to leap. But you wouldn't just jump, right? You'd check if there's solid ground below. Treat your trades the same way. Before making any decisions, do your homework. All right, let's get real. You know what messes with your head as a trader? Theories. They sound nice on paper, but fall flat when you're staring at that chart, hoping for a miracle. Everyone craves real success, something that excites you but actually works. I've been there, felt the frustration. Doubt creeps in. Will you ever get it right? But here's the deal. I turned those theories into tangible wins. Let me share a few personal stories that shaped my trading journey and led to a 91% success rate. Each taught me a valuable lesson I still rely on today. Imagine this, I dive into the Forex market, and like a rookie, everything goes wrong. I lost big. And not just a few bucks, we're talking gut-wrenching losses that left me questioning my path. It wasn't until I stumbled onto a simple moving average strategy that things changed. I documented every win and loss, analyzing patterns and tuning my approach. Following the trend instead of betting against it reignited a spark. I had a plan that worked. Fast forward and I hit gold. It was exhilarating. Strategy refined, buying on dips, checking indicators, watching support levels. Watching my account grow was something else, but here's the kicker. I didn't just celebrate. I went back, examined my wins, and embraced losses as lessons rather than red marks. Don't let anyone fool you, it's not all sunshine. Losses are part of the game, and I'm not shy about owning them. I've faced wiped accounts and emotional highs. But those losses? They taught me resilience. They pushed me to refine my strategies and be smarter. Let's get real. A breakout trade once left me stunned when the market reversed. Instead of shrinking back, I adjusted my entry points and tweaked my stop-loss strategy. I learned the hard way, but that lesson fueled my success. All these experiences, highs and lows, built my confidence. They paved the way for my trading success. So, if these strategies worked for me and I came from where you're at now, think about it. They can absolutely work for you too. What's holding you back? Subscribe to TradeUp, the new best trading channel on YouTube, and like this video. I'll see you in the next one.